Hello, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for July 12, 2022, episode 208. I'm Dean Croak, market analyst here at DAT. I'm sitting in for Ken Adamo, and I'm joined by Ned Damon for the last time on the show. He's been DAT's principal data analyst for 7 years, and we'll get back to him a little bit later on. And today we've got a special guest, Cole Hitchon, DAT's product manager, who's going to be talking a little bit later about DAT's new True Rate product. Good morning, guys.
Good morning.
Morning.
How's it going? Good.
It's been hot.
Yeah.
I mean,
yes.
Portland doesn't normally get into the 90s, and it was 95 yesterday, so we were sweating a bit. But overall, pretty good. How about you, Cole?
Yeah, it's pretty warm in Minnesota, so it's hot and humid here for sure.
Yeah. So it's interesting to see diesel prices cooled off a bit, talking about weather. That was good news yesterday. Dropped about 10.5 cents, I think, yesterday, according to the USDA national average. By my calculations, that's down about 24 cents in the last 3 to 4 weeks, which is great news, I guess, if you're a carrier paying retail price. Also good for shippers, right? So the net surcharge at DAT is down about 2 cents to 72 cents this week.
Yeah, I think that'll really help for people who like high line haul rates. It'll help give a little bit more oomph into that. I don't know what the kind of ceiling is on how much that can go, how much lift that can give, or the floor on how low diesel can go. But you were mentioning also this morning that West Texas crude is also down, so that might be a sign that there could be further reductions going forward.
Yeah, it's just under $99 or just under $100 per barrel this morning. So it hasn't been under that for just over a week. I think it came under $100 and then went back up, I think, about a week ago. But that's good news. Jason Miller's done some great forecasting on the relationship between crude oil prices and diesel prices, if you want to check out his LinkedIn posts. So, all right, well, let's dive into the show, guys. We've got a lot to cover. For those new to the program, we're here every Tuesday at 10 a.m. Eastern, 7 a.m. Pacific, talking about trends in the freight market. Most importantly, though, we're going to answer your questions. Drop them into the chat section. They tend to pile up towards the back end of the show, so get the questions in as soon as you can. We've got a team of people looking at those as they come in and pushing them through us on our live screen. So with that, we'll get into the freight market update. Today, we're looking at a couple of trends. Reefer spot rates cooled off predictably this week. No surprise there after the July 4 break. But flatbed and dry van rates remain flat. Somewhat of a surprise. Ned's going to dive into that towards the end of the show with his forecast. Piers, JOC sister company Piers, imports are up 2% in June. It looks like being the second busiest on record. So lots of import volumes coming in. Volumes are up substantially on the East Coast, particularly the Port Authority of New York and New Jersey. Volumes are up there about 24% year over year. They even said in a press release last week, they're up about 33% on 2019 levels. Not surprisingly, though, LAX volumes were down about 5% year over year. One of the trends we are watching this week is the phenomenon of vessel bunching. Last year, Los Angeles was the big story with the peak in vessels at anchor up around 109 vessels on January the 9th. It's down to 25 today, so a substantial drop there. But as we've talked about, the vessel congestion is now moving to the East Coast. New York City yesterday morning on marine traffic had about 18 vessels parked offshore at anchor waiting for a berth, and Savannah has 37 as of yesterday morning. An interesting report from Jeff Lentz, CEO of Georgia Port Authority. He said that higher than expected import volumes will likely exacerbate the vessel backlog in coming months. He said there are roughly 255,000 containers on the water headed for Savannah. That's up from 210,000 last fall. So lots more volume coming into Savannah, lots more congestion, which means more volume spilling over into the spot market for truckload carriers. The produce season wrap, a bit of a disappointment for a lot of carriers and growers, of course. Peak July 4 volumes that we normally see were the lowest since about 2015. And truck orders continue to show that there's pent-up demand. According to ACT research, the backlog is out to about 230,000 vehicles, stretches well into 2023 for new orders being delivered. According to Kenny Veith at ACT, there is no sustained cancellation activity evident as of the last report last week. And one of the other things we're watching is that there's some protest action by dray carriers in Los Angeles scheduled for tomorrow. Depends whether, if that goes ahead, that'll be an interesting move by some of the local dray carriers. Of course, they're protesting about a lack of a carve-out for owner-operators as it relates to the new AB5 bill that's been passed. All right, so with that, let's dive into the freight market report. We'll start off with dry van load-to-truck ratio. Load post volumes predictably decreased during the short work week last week. Volumes are down about 11%. I did notice more carriers taking time off than this time last year. Equipment post decreased by about 18% last week. As a result, the load-to-truck ratio dropped slightly to 4.61 loads per truck. In the refrigerated load-to-truck category, according to the latest data from USDA, volumes of long-haul produce are down about 15% compared to this time last year. California is the big disappointment for carriers that were looking for lots of volume. Volumes look to be about the lowest in 20 years, contributing to the decreased national reefer total. The caveat with USDA data, especially California, is there's always late reporting of some volumes, particularly including citrus. We'll continue to see volumes increase over time as the reports come in. We'll keep updating the crop reports as they emerge, but so far it's looking like a pretty bleak season for California produce growers. Like dry van and reefer, equipment posts for refrigerated were down about 8%, and respectively, the load-to-truck ratio for refrigerated increased slightly to 9.04 loads per truck. And in flatbed, load post volumes are about 22% lower than 2018, when, of course, the flat market, bull market started to turn down in about July. Load post volumes last week were almost identical to 2020 levels. They continue to track seasonally, the closest, though, to 2018. Equipment posts are also tracking very closely with 2019 levels. That was when the market was oversupplied with trucks. So we're seeing flatbed load post volumes around 2018 and equipment posts around 2019. As a result of lower load posts and equipment posts last week, the flatbed load to truck ratio decreased to 26.67 loads per truck. Having a look at our market condition index, we'll start off on the West Coast. Containerized import volumes were up around 2% nationally, and even though that's 8% higher than the previous year, volumes last month in the ports of Los Angeles and Long Beach translated into lower load post volumes on the truckload side. Last week, load post volumes were down 35% last week. That was the first time they'd been down in the previous month. Outbound spot rates, as a result, in Los Angeles dropped 2 cents a mile to $2.25. The opposite was the case, though, on the intermodal heavy Los Angeles to Chicago lane. Spot rates increased 14 cents a mile to an average of $1.81. That's still 90 cents a mile lower than this time last year. Over in the southeast in Atlanta, load post volumes and spot rates were down 16%, but rates were up 3 cents a mile, respectively. On the short haul lane to Charlotte from Atlanta, spot rates dropped by $52 a load to an average of $7.28. That's about the same as $2.97 a mile. That's excluding fuel, of course. Loads west to Houston from Atlanta were flat at $1.62, but 67 cents a mile lower than this time last year. In Chicago, outbound volumes have increased by 13% in the previous month, following last week's 2% week-over-week increase. Spot rates also increased outbound to Chicago for the third week, following last week's 6 cents per mile increase to an average outbound of $2.21. In Elizabeth, New Jersey, it was the #1 port for imports in June. Capacity tightened. Spot rates increased by 3 cents a mile to an average of $3.72, and loads from Elizabeth to Atlanta increased by a penny per mile to $1.50 after dropping by $1.36 per mile since February. Having a look at the refrigerated market, capacity was pretty tight in Ontario last week. It's been tightening for the last 4 weeks in a row. Spot rates have increased by 21 cents a mile in the last month to an average outbound rate of $2.90. On the short haul lane from Los Angeles to Las Vegas, rates were flat at $5.25. In the Pacific Northwest, load post volumes have been surging outbound Seattle. They've been up 76% so far in the previous 6 weeks. That has pushed spot rates up by 23 cents a mile to an average outbound rate of $1.47. Spot rates on the 1,500-mile haul to Phoenix were up 2 cents a mile to $1.11 to compensate for decreasing rates in the opposite direction from Phoenix to Seattle. In the overall Phoenix market, rates were down considerably, though. Last week, they dropped by 13 cents a mile to $2.78, while loads east to Los Angeles were down 68 cents a mile to an average of $2.54 43 last week. Significant collapse in rates there. In the southeast region, the USDA is reporting a shortage of trucks for loads of sweet potatoes, pushing up regional reefer rates. In Raleigh, North Carolina, rates increased by 43 cents a mile to an average of 267. And on the 580-mile haul west to Bowling Green, Kentucky, spot rates are up 33 cents a mile to 258. That's the second highest reading in the last 12 months. Reefer capacity was also tight in the Houston market last week. Spot rates increased by 13 cents a mile to an average of 228. Having a look at our flatbed market, after dropping for the previous 3 weeks, load post volumes surged last week. They were up 86% last week out of Laredo. Capacity tightened rapidly, pushing up spot rates by 28 cents a mile. The average outbound rate from Laredo was 286. Laredo to Fort Worth, rates are up 26 cents a mile to 289. That's also the second highest reading in the last 12 months and about 2 cents a mile higher than this time last year. On our number one flatbed volume lane from Houston to Fort Worth, rates peaked at a 12-month high of 429, even though load post volumes were down. So capacity tightened there as a result last week, even though volumes are down about 2%. In the Midwest, capacity tightened in Kansas City, Missouri. Load post volumes were up 63% last month. Spot rates have followed a similar monthly trend, up 7 cents a mile to an average of 227. And from Kansas City, Missouri, 600 miles west to Denver, flatbed spot rates were pretty flat at 248, while capacity loosened on the short haul lane to Atlanta, where they're averaging about 505 per load. Wrapping up our market update with our year-over-year view of spot rates, dry van line haul spot rates on the top 50 lanes, measured by volume of loads moved, averaged 242 last week. That's about 44 cents a mile higher than last week's national average of $1.98. Line haul rates were mostly flat last week compared to the previous year. They're 42 cents a mile lower, but still 28 cents a mile higher than the average of pre-pandemic years. In the refrigerated sector, typical season spike in reefer rates driven by peak produce volumes failed to deliver this year. We predicted that would have been the case about 3 months ago. No material impact in produce season resulted in pretty minimal increases in spot rates overall on most of the lanes. Reefer line haul rates dropped by about 90 cents a mile this year. They were down about 5 cents per mile last week. And as we start the second half of 2022, reefer spot rates are currently averaging about 227 a mile. They're line haul rates excluding fuel, of course. Rates are now 54 cents a mile. Line haul rates, that is, are 54 cents a mile lower than this time last year, but 26 cents a mile higher than the average of pre-pandemic years. And lastly, in flatbed, line haul rates were flat last week, ending at around 251 a mile, excluding fuel. Demand is clearly cooling off for flatbed carriers following the 11 cents per mile decrease in spot rates in the last 4 weeks. With 2018 the best season to figure out which way rates are going directionally, as you can see from the chart. Spot rates are now 23 cents a mile lower than last year, but still 7 cents a mile higher than in 2018 and about 49 cents a mile higher than the average in non-pandemic years. So that's it for this week's DAT market update. Remember, if you'd like to find out more about what's happening in freight, go to dat.com, market update, and download our weekly report, which will be published this evening. And with that, it's over to Ned for the short-term forecasts.
Hello, everybody. We're going to be beginning with dry van. In blue, you can see the market rate observed by DAT. And then off to the right, you can see our forecast models. In red, our short-term model is predicting that the current slightly downward trajectory is going to continue forward. I think it's being a little over pessimistic, especially given recent fuel trends, but we will see. It's dropping down to about $1.85 as we move into the middle part of August. In green, our ratecast model is expecting a similar drop early, but then by the middle part of, or closer to the middle part of July, it's breaking back upwards, returning to about current conditions as we roll forward. In gold and silver are our blended forecasts, which are mixtures of the two forecasts in different amounts and in different ways. And the blended forecasts are kind of straddling the space. They're seeing a drop continuing a little bit further forward before leveling out at about 5 cents below current prices. Moving on next to our reefer forecast. Once again, in blue, you can see the market rates observed by DAT. And then off to the right, you can see our forecast models. In red, the short-term forecast is expecting a saturating drop with breaking, that is, going down to about 220 as we head into the middle part of August. In green, our rate cast model is expecting a similar sort of a behavior with a slightly sharper drop early and a slightly higher pullout later, stabilizing again at about 220, maybe a little bit above with that level. And gold and silver are our blended forecasts, which are mixtures of the two forecasts in different amounts and in different ways, and they're leaning a little bit more towards the short-term model for reefer right now. Finally, with flatbed, we have once again in blue the market rates observed by DAT, and then off to the right you can see our forecast models. I'm going to start off with our rate cast model in green, which is expecting a little bit of a drop, and then kind of a period of flatness and then a more sustained drop, leveling out at about, or continuing down to about 240 by the middle part of August. In red, our short-term model is just trucking on down, heading down to about 225 as we head into that middle part of August. And then our blended forecasts in gold and silver, which are mixtures of the two forecasts in different amounts and in different ways, are leaning much more closely towards the short-term forecast for flatbeds right now. And with that, we are through the forecast models, and we're on to our IQ question of the week. That is talking about, now that a load rate is available, how is that going to help brokers?
It's a good question for Cole.
Yeah.
Yeah.
Excellent.
Yeah.
Sure. So, I mean, we all know data is super powerful, right? So, specifically this tool, we've been researching and trying to figure out a way to create a predictive approach when it comes to, helping, industry experts or brokers make decisions about, moving freight today, tomorrow, next week. So, what we want to do is just offer, a different lens on how we kind of approach this. So we know that shipping hazmat out of a tight area is different than shipping hazmat out of a loose area, right? So what we want to do is really try to illustrate that story on why they're different and how they're different, and give that power back to the user, right? So you communicate either how you, depending on, so that you can either articulate decisions on how you're going to buy, but also sell. So yeah, with that, I mean, it's intended to be a low-level rate that's different from what we produce today, and then of course have specific attributes that you can actually add to it to try to procure that rate.
So that's a good introduction. So one of the more common questions I think we get, Cole, is how is True Rate different to Rate View and Rate Cast?
Totally.
You've spent a lot of time in the brokerage business, so give us that perspective.
Yeah, so yeah, it's intended to be a load level rate, which means coming from like the logistics, like having a logistics background, like lane versus load. So when we talk about lane, we're really talking about averages that make up that specific lane average. So it could be a variety of different attributes that are thrown in there, slightly different locations, etc. So when we're talking about load, we're talking very more specific about, I have load criteria in my hand right now. Give me a rate for exactly what I have. And so that's what we're really trying to target. So one, it's the attributes that are specific to that. So you can, of course, hazmat, multi-stop, etc. But then what makes this unique as well is that modeled approach, right? So I know that I'm going to ship something next Friday. I want a rate specific to that day because there are parameters or specific economic conditions that might dictate, what it's like to ship one day versus another.
If you wanted to use this new tool, what kind of a time period do you feel like is best? Like if I'm a floor broker versus a pricing guy?
Yeah, so optimal time is between today and 2 weeks. We're exploring ways to try to figure out that kind of awkward position between kind of beyond 2 weeks and RFPs, right, which I know is a desirable time period, mini bids, upcoming projects, etc. But specific right now, where the optimal time is between now and 2 weeks.
So if, say, you had tickled my interest about this and I were a broker or a carrier, how would we get in touch about this product? Do you have a timeline that you're interested in demoing or
yeah, we're
allowing access to customers?
Totally, yeah. So we're in the infancy stages right now of just getting a couple customers using it from like an alpha stage. Beta stage, we're hoping to deliver by the end of the year. So more info to come on that.
Anything that you want to add? Closing thoughts before we move on to our listener questions?
Yeah, sorry, go on.
Oh, sorry, pardon.
You're right.
Yeah, the only thing that I would add too is the cool thing that we're really working hard to try to solve kind of the industry expert or broker problem here is not just delivering that low level rate, but more so like providing intelligence, right? So we've got all these tools, existing tools. How can we supplement those existing tools with this low level rate, but then offer it in different ways to look at how they can communicate how freight rates matter and differ depending on time and attributes, et cetera. So being able to offer multiple shipping days multiple rates across different days, maybe there are different modes that maybe your customer might be interested, something like that. So that's our target goal here, is just really add more value.
So to sort of cover, if someone's looking at our traditional suite of products like RateView, for example, the difference would be that RateView is providing a historical view over tens of thousands of lanes over time, as in what the freight moved at on a lane, an origin destination pairing. The difference here is with True Rate, we're talking about a specific shipment on a lane, as opposed to the rate for the origin destination pairing. That's the significant difference here, is we're actually helping brokers figure out what the rate is based on some really important things like lead time, picks and drops, weights, dimensions, hazmat, even team. I think you have team in there as a category too. Is that right?
Yep, exactly. Yeah, the other one that we'll have right out the gate too is partial, as we know that it's also an important attribute that people are looking for.
Right. Are you looking for folks to connect with you for more beta testing?
Absolutely. So yeah, my email is really simple. It's cole.hitchon, my last name. Super unique. There's about 10 of us in the US. So cole.hitchon@dat.com.
Okay. You can put that in the comment section, I guess, Ned, if that's not going to blow up your email inbox. Yeah, that's great.
Ready for some listener questions?
Yeah, let's go.
Brian asks, are we seeing any change in productivity through the LA ports, given we are into overtime on the dock worker labor negotiations?
Not yet, although I did mention at the top of the show there is some protest action by dray carriers in the LA Long Beach port area. We think it looks like it's going to impact dray carriers predominantly, especially the least on carriers. They appear to be the ones that are the least informed about what's going on, the most concerned, the most confused, and the most impacted. Those guys, based on social media posts that I've been tracking for the last 4 or 5 days, are planning some sort of action tomorrow. So I expect the answer to that question could emerge tomorrow. If nothing happens, then we'll know the answer will be that the impact's going to be, I think, mostly in the dray area, I think is where we're going to see it, although we do see some impact for least on carriers that are running in the longer distance lanes, but mostly it looks like a dray carrier issue at the moment.
Mihailo asks, last year the split between contract and spot was 75-25. This year it's closer to 90-10. Will shippers participate more in the spot market in the future, or will they renegotiate contract rates during 22?
What do you guys think, Cole? He's gone quiet. I think based on our discussions with Dr. Chris Kaplas, there's always some shippers that play the spot market. I think one of the things that he said was very interesting. MIT did a study on carriers and shippers, whether they were elephants or goldfish in terms of memory, and it was kind of a fascinating study that they produced, and it said that carriers were more like goldfish. They were more reactive to the current market, but shippers were more like elephants in terms of their memory. And his view, based on the FMIC consortium of shippers within the DAT network, is that they are sticking with their contract carriers on the heavy lanes, and maybe some of the smaller volume lanes where there's 1 or 2 loads a week, they are letting them go to the spot market because they were essentially carved out of a lot of the mini bids last year. So some of those low volume lanes they're letting go to the spot market. But generally, the shippers weren't playing that game because they realized that if they accelerate the bleeding off of capacity by driving down the spot market, they only end up back in the same position they were in last year sooner, as in capacity very tight and spot rates going up again.
Yeah. To add to that, I mean, last year, one of the reasons why you had to play the spot market was because the spot rates were so high relative to contract rates. When you had a growing market, there is going to be a need to play the spot market in order to get and maintain the capacity that you need to get through. This year, with spot rates dropping, that is less true. You might expect to see a little bit more in the other direction, but one of the constraints on that is that to the shipper, and people point this out all the time at DAT, to the shipper, the price isn't actually dropping that much. The line haul rate is going down, but if you consider like the total rate plus fuel, which is essentially what the shipper is paying, that's not dropped by very much. And so there's not like a real advantage to trying to move loads on the spot market from a pricing perspective.
Yeah, I will add too.
Does that make sense?
Yeah.
Yeah.
I think totally too, from an optimization standpoint, too, shippers generally like to participate in that contractual agreement because of the guaranteed capacity. So something to consider as well. Just the spot market is sometimes a little bit, you're gambling a little bit.
Yeah. Yeah.
And
the downside.
Yeah, sorry.
Go ahead. No, please go ahead.
Well, your service levels are affected too, right? So as soon as you drop down through the routing guides into lower rates and in the spot market, you're going to have lower service levels. So I think it really depends on the shipper, the lane, and the type of commodity, and what sector it's in, whether it's refrigerated or flatbed.
Yeah. A final note about that, at least from me, is that the upside downside risk, like if you're a shipper and you save a couple of bucks, that's not necessarily going to be that big of a win for you. Whereas like if you have a service level failure, you can't move your freight, or prices are outside of what you've budgeted for, that loss is much bigger than the upside. So you want to try and do like risk minimization.
Yep.
Yeah.
Okay.
We have a question from Alexander. 8 months ago, one could not find a truck for sale at all. Now, based on social media observations, I see truck for sale, and anyone hiring an experienced driver posted a lot more. Would the experts say there is an indication that we are seeing the effects of the market correction already?
In terms of spot rates, yes, we're seeing a correction, but it's also offset by the higher contract rates that carriers are gravitating to. So you remember that any exodus of capacity will certainly be some of those carriers that are exposed to the spot market, especially those carriers in the power-only category, where rates are dropping substantially. But remember, spot rates are still higher than they were in pre-pandemic years. So I don't subscribe to the doom and gloom theory. Carriers are coming off their best year financially in 3 decades last year. Carriers are very well capitalized at the moment. Remember, 90% of the freight's moving on contract right now. Those large truckload carriers are reporting substantial quarter-over-quarter increases in both revenue and income. So trucking companies are doing really well. I think people have been misled by this talk about the market collapsing based on spot rates only, because spot rates were dropping and volumes in the spot market were decreasing, largely because carriers were honouring their contract rates at the top of the routing guides, where rates have been as high as they've ever been. So that's sort of my take on it. You guys, what do you think?
I mean, I think that there are probably going to be some margin carriers where they got in really late last year, or for whatever reason they couldn't have that capital cushion, and especially if they're using equipment that's not very fuel efficient, they're going to be really, or they're not part of a fuel recapture program. They're going to be really squeezed right now. But I think that for a lot of the more stable folks, you're probably not quite seeing any serious downside yet.
Remember, a lot of the guys that were affected in the 2018-2019 cycle, that was their first cycle. And the difference between then and now is they didn't pay nearly as much as they've been paying for used trucks in the last 12 months. They've been paying double what they would normally pay in the last year. So I think the carriers that are impacted the most are ones that have had to suffer through very high retail prices for used trucks that are out of warranty with high operating costs, as you mentioned, Ned, but also high insurance costs. Our blog post this week is talking about insurance costs, which are increasing, not decreasing. Cost of claims is increasing. Medical costs are increasing. Accident rates are increasing. So there's lots of things working against carriers in terms of some of the baseline cost. Insurance costs are typically about 5% of operating costs, nowhere near what the cost of diesel is today, and wages. They're the two big ones that will affect carrier profit margins the most, is fuel and wages. Of course, they can't take away the wage increases they've been providing in the last year, but fuel prices are coming down. That should provide some relief for some of those carriers on the margins.
Yeah.
All right, Cole, anything?
Nothing to add, no.
Okay, all right. Well, that brings us to the end of the show. If you've got any more questions that didn't make it, you can always hit us up at askiq@dat.com, askiq@dat.com. That email hits our inboxes and we can answer those questions pretty quickly. Remember, if you want to find out more about what's happening in freight and get some of the charts, you can download our weekly market update at dat.com/market update. Some of the shout outs today, I'll be on the Sales Chatter show tomorrow morning, as I am every Wednesday, with Dan Deegan and DJ Flores at 9 a.m. Eastern. You can connect with them on LinkedIn. Stephen Pettit's going to be on Landline Now at 7 p.m. Eastern tomorrow night on Road Dog Radio Channel 146. And on Road Dog Radio, I'll be on with Jimmy Mack on Radio Nemo at 8 a.m. Eastern. And remember, Operation Safe Driver Week started last Sunday and ends on Saturday. The focus is on speeding and distraction this week. Lots of activity on our highways. Everybody needs to keep their head up. And with that, we'll bring our show to a close. Ned, I'd just like to say I've absolutely loved working with you. Thank you very much for the time. I've only been here 2 years. You've been here 7, so you have a lot more history with the company. But I found your forecasts both accurate and
valuable.
I got timed up with illuminating and accurate, both accurate and illuminating.
Thank you so much. I've really enjoyed doing the show. I've really enjoyed working with Dean. Working with DAT has been just something that has been wonderful. The people, the projects that I've worked on. But I've been here 7 years. It's time for me to move on to something else.
Good for you. All right. Thanks, Ned. We'll talk to you soon. And with that, we'll bring our show to a close. Everybody have a safe week. Thank you for watching.
Bye.